Hi everyone, welcome to the second video for the Electronic Trading Club. Before we all jump into the nitty-gritty of when to buy and sell, I thought that I would just give a bit more of a background of myself, so that you get to know me better, where I've come from and what path I've walked. This video is about an introduction on me, and then it goes into some fundamentals on setting up your trading structure as a first discussion point. To start off with, here's my academic background. You can read this on the first slide. Quite honestly, it's rather unimportant. If you read Market Wizards, for instance, you realize that anybody can participate in the markets. It really just comes down to your strategy, personality, and consistency. In May 2008, I got into the whole investing business by starting a small investment club where we'd buy some vanilla equities. I was a big follower of Buffett principles at the time. I bought when everybody else was selling and focused mainly on quality blue chips. We did well. We always outperformed the market year on year. We only invested in pure equities, no derivatives, whereas most people will tell you it's because I was so skilled at buying this and I did my valuations on that. I'd rather be honest here and tell you that a good degree of it was luck. At the time I had an aversion of the resource sector, and I simply stuck to the blue chips and the industrials and just left it. Buy and hold, as they say. I realize now how much things like stimulus played a role in my returns, how much of it was me, how much of it was luck. Anyways, to cut the story short, it gave me confidence at least to get into derivatives. It turns out that derivatives are a completely different ballgame. I went through my learning curve on that as well, and it was steep, and quite honestly it was gruesome at best. Through long periods of time it can be a horrific experience, especially when you go through it alone. This is where and why a lot of traders give up, but I went on studying. I had a passion for the markets and that got me through it. I went on a journey to figure out why this whole trading business is so difficult and how can it actually work. I'll go through my setup a bit later in the slides. What I do believe is that, in a very simplistic summary, is that it really comes down to two things: how you capitalize yourself and what your methodology is. When those two pillars aren't right, everything else comes crumbling down eventually, no matter how good you are. A fascinating story to read is the story on long-term capital management, a team of the best who nearly single-handedly crashed the entire financial markets. On the slide I've put a link to some of the story at least, which is definitely worth reading a bit later. But to get back to my story, I started with the usual chart patterns, reading technicals, candlesticks, the stuff we all start with. I'm quite sure most of you seeing this can relate and found that it just didn't work for you either. So I adapted. And with some help of friends and others, I started getting into systems. Eventually I went through the process of reading up on it, designing it, testing, optimizing the works. I found the system, now I'm ready, I'm a real trader, so I started. What I'd like to show you on this slide is here's a statement of the month I started my Ultra system in. Right off the bat, it was a great month. It was up 13% for the month, or 21% from the worst point, which equated roughly to 35,000 Rand profit in that month. Starting off like this gave me a good experience of systems, consistency, psychology, and so forth. It gave me experience in the field, and of course, at the time, a bit of ego. On the next slide, for those who follow the Aussie, you can see some of the results of my system I was working with. Backtesting resulted in over 10,000 points in some years, never a losing year, and forward testing showed 100% return per annum, some years more. Maximum drawdown was only 2,800 points, a win ratio of 45%. In my eyes, I was quite happy with the results of it and decided it was a good system. So I'd done my homework and I officially started the system. I had a great month, and then I hit one of those drawdown periods. No hassle, they don't last that long. I've done my homework. The system went into its longest drawdown since testing. It lasted 13 months just to get back to break even, no profits yet either. After 8 months of break-even to losses, I threw in the towel with losses. If you look at the results, had I stuck it out for 5 more months, I would have at least broken even, and had I stuck it out for another 3 months after that, I would have doubled the account. The reason I mention this specific period is because everyone here should know systems are more than just buy and sell. Even if we don't focus on capital management or asset allocation as much in our future discussion topics, it is a very necessary component of systems trading. This is what the club is about. It is about sharing knowledge with other people interested in systems, what pitfalls there are, what to avoid, and not just within the testing itself. It is about learning together how systems and the pillars around it really work. So to almost fall into our first topic on the first meeting, this is something I specifically wanted to mention, especially to those who have less experience. I find that this topic is rarely ever covered in trading seminars or presentations because, quite frankly, who gains from this? As I pointed out last time, I don't want this to get into a how to trade seminar, but I do believe this experience is something worth sharing before we rush off into our first system. In my experience, and the experience I saw with other traders, was that in this chart you can see that the more money went into trading, the more emotional capital affected you exponentially. The problem with the topic is that even if people mention things like trade small, nobody really ever gives you specifics on anything, besides maybe the 2% rule. And so you just go ahead anyway. I learned over my experience I had to change things. I learned how incorrect capitalization, stability, obligations, debts, monthly expenses, all of these things have effects on your trading, even if it is using trading through a robot. I recommend trade 20% is the sweet spot. This should not be mistaken for financial advice and the usual clauses that come with it. I really can't give financial advice, but what I can do is I can tell you what my ideal setup is. The setup is firstly to have safe, stable income, and then secondly to only trade with 10 to 20% of your total net worth. If you look at the example, you'll see how 80 to 90% is in assets like your house, your car, some savings, pension funds, and then only 10 to 20% then gets allocated to the systems portfolio or your trading account, which will most likely get split even further into different types of systems. So if you were worth R1,000,000, then 800,000 would be in making sure your debts are paid off. You own a house and blue chips, maybe so on. Only a maximum of 200,000 would be invested in a trading account. The question you may ask at this point is, well, what if I don't have R1,000,000? The answer is simple. Play it smaller. Instead of the Aussie, for instance, play the Olmi. Use less gearing. For example, this system that I was showing you earlier required 80,000 Rand per contract if I played the Aussie. So if I played the Olmi with it, it means I only require 8,000 Rand per contract. If things go poorly, and at some point it will, you need that backup, that 80%, because even if you believe in your trading methodology, you have to have other sources to back you again if things do go wrong. If they do go wrong, you want to start again, and then you use the profits from the safe accounts and not the capital itself. It's very important that the capital stays stuck there. The problem is the market environments change every couple of months, so any system will at some point go through a period where it struggles. If the market is sideways, breakout traders will struggle. If the market is constantly trending, then mean reversion will struggle, and vice versa. Now, expenses like debt are your biggest psychological killers, because you have to make payments every month. And if you don't have enough income to make payments, or you're making losses that month, then you start to do silly things on the market. In the next slide, you'll get a better idea of what I'm talking about. There are many approaches to this, and depending on your background, I can already hear many rushing up citing models like CAPM or other models which are better. What I'm trying to get across is the concept of a waterfall type approach. This is what I prefer as a setup, where profits only move downwards from a lower risk to higher risk category, so low, medium, high. Please note that only system profits move back up the chain, back into low risk investment again. How this relates to systems is that this is something you need to decide before entering your system, or how much can I allocate to this algo. The markets are stressful, as you saw with the earlier system that had made 100% returns for the year. However, it went through a 13-month drawdown. The only way to beat the stress is to make sure that you've got backups running in the background. This model isn't about the best financial return. This model focuses on the best return when taking all capital elements into consideration. This includes emotional capital, being stress and happiness, as well, which the models like CAPM can't do. You need to find a balance between it all, the tangibles and the intangibles. In the next slide, I'm just going to show you a quick example of how to apply our waterfall approach. This just shows you that in a perfect world what can happen playing it safely. Starting off with a net value of 500,000 Rand for this person and a net amount of 15,000 Rand for this of savings. So that 15,000 Rand means that you've paid off the house, you've paid off the car debt, you've paid off the groceries, you've paid off the electricity, the cell phone, etc. I take those savings and I apply it to this waterfall approach accordingly. Here you can see the weightings. 5% goes to cash, 45% goes to prefs, 30% equities. Those three sum up to 80%, being my low to medium risk investments. The last 20% then goes to my savings account, which is 100,000 Rand, or 20% of 500. And then 20% of the monthly savings also get contributed to that fund. I see that in the first year, it doesn't even include contributions from your salary. That only starts from the second year. On these assumptions of preference shares paying 10% dividends, the market growing 15% year on year, and your systems making 100% per year every year, you can see after 5 years that with this investment methodology, you turn the 500,000 plus the 900,000 of further contributions, so a total of 1.4 million, you've turned that into the 3.5 million. Even though this calculation does take tax into consideration, this obviously is a perfect scenario. The markets don't always do 10% every year. Some systems don't always do 100% every year. It doesn't always work that way. But I once heard and thought it to be very good advice was this: having no plan guarantees failure, but unfortunately having a plan doesn't guarantee success. It does, however, put your odds more in favor of success. Finally, here's some last tips you can read a bit later, but hopefully by now you realize what I'm trying to get across. You need to ask the questions, what if something in my trading goes wrong? Sometimes it's not even in your control. A recent example was the Swiss central banks that unpegged the Euro-Swiss exchange rate. Overnight, major companies like Alpari went bankrupt. These are events, especially in these days with the central bank's constant intervention, that happen that you need to be sure that you can survive. Having gone through my rant about risk, what I can say about myself is I enjoy reading fundamentals in economics, and I like my systems, like the back testing. That's all me. And finally, here's the last slide that I just quickly stuck in here. Here's some topics that I thought of that the club can discuss. Obviously these topics are open and nothing is set in stone. All suggestions are welcome. We've got moving averages, we've got risk techniques, we've got some indicators like Bollinger Bands. I'm very excited to hear from other members' experience, what they've had with some of these, like Bollinger Bands. Some say it's rubbish, others swear by it. I'll be showing you some interesting data on that one, some things I've picked up, my views on it. But that's the whole presentation. Again, thank you very much for listening, and I hope you enjoyed it.